In episode 1, we talk about why most traders lose money in ranges. Now in this episode, I'm going to show you exactly how I trade them. This is basically my bread and butter setup, the range deviation trading setup. Most of my wins over the last year come exactly from this specific setup that I'm going to show you today. This is the range trader trilogy, and we saw on episode 1 the reason why people lose money on ranges. We will see in this episode my exact 5-step process for trading range deviation, and in the last one, episode number 3, I will show you some pro tips and some advanced tricks to use in ranges. But let's start with a very quick recap. What is basically a range? A range is a price action where price goes sideways. So instead of forming a bullish market structure or a bearish market structure, price is simply, like Bitcoin like to do many times, going sideways. So ranges are characterized by 3 boundaries: value area high or range high, the top of the range; value area low or range low, the bottom of the range; and mid-range, point of control or fair value area, the middle part of the range. The edge in a range for a trader are always the extreme, and this is where money is. So what I trade the most is usually deviations in top of or in the bottom of the range, because money is there, so people get trapped, and we get a deviation that push the price to the other side. So this deviation for range trader, and especially for me, are simple opportunities to make some money. So we will go now in the 5 steps, my exact 5-step process for trading range deviation, and you will see that these steps are mechanical and repeatable, so something that you can apply on your trading journey. So the very first step is that range should form and should be well established. So this is very important, because many people try to trade range when actually the range is still not there. The range is still not formed. So basically the input here is you can't trade a range that isn't a range yet. So what we need to establish that a range is there, a range is formed, is the boundaries. So as I explained in the first video very well, but here in the quick recap, a range need to have basically 3 boundaries. And now I'm looking the 12 hour on Bitcoin, but we can use many other time frame. You will find the ranges everywhere. And what we need first of all an upper boundary, so should be formed, and we should have some interaction, and should have a lower boundary again with some interaction. Last one is the middle. This is a double check you can do in all your ranges to see if they are properly ranged and if they are properly formed. Is the mid-range or the point of control in the middle, and you want to see this area with a lot of exchanges, or this area to be a little bit respected as temporary support and resistance. So you have these 3 boundaries, and you have to have a certain number, 1 or 2 touch in each side of the extreme, and also some touch, some interaction in the middle, to confirm that this range has a meaning. This range has been formed at least a little bit. Now we can select range in many ways, but just to show you a few examples, this is another one where you see the 3 characteristics: high is tapped, low is more or less tapped, and you can see here the middle part has a lot of interaction and is a relevant level. Let's say you want to see this level to be relevant. You see also mid-range is relevant, not just the top and the bottom. Also a range should have the absence of market structure, because we say price can do 3 things: uptrend, downtrend, and range. So in an uptrend, we have a bullish market structure. In a downtrend, we have a bearish market structure. In a range, we don't have a market structure. So also the absence of a market structure. Once you see this, you can also pull an indicator. You have a video here in my Learn and Trade series that is the a video on fixed range volume profile. And the other things you want to do is point of control, that is median line, to have some volume here in the middle, a little bit fat, that show you that actually mid-range is really an area well traded. So the range needs to be mature. So price has to bounce between the boundaries enough time that they become kind of obvious. Volume profile will only give you a clear belly, let's say, curve in the middle, and will give you also, if you want to be objective, volume area high and volume area low. So let's say at least a couple of touch in each key level show you some maturity on the range. My pro tip is, if you can draw the range in 5 seconds in the chart, probably is not ready or probably is not a range. So if you get confused because of the price action and you cannot clearly see the range where it is in 5-10 seconds, probably step 1 is already a red flag for you, because the range is not there or is not well defined. So the step 1 on my 5-step process for trading range deviation is range should be formed and should be well defined. So step number 2 is the range have to break. Basically, here we are trading range deviation. So what does it mean? What does it mean? That we want the range to be established, as we say, with a few taps. Let's say price is coming from a downtrend, start to range in these boundaries. We have a couple of taps. We know that more or less here there was some interesting price action on lower time frame. So also mid-range is respected. So what we want to see? We want to see a break of this range. Let's make the bearish deviation example. So this range that we have been looking for has been broken, temporarily broken. So this is where 90% of the traders make their mistake. They chase the breakout. So they see a support and resistance level being broken up or down, and they try to trade the breakout because they hope that price will do something like this or something like this. So they chase the first move. So what I do, or what range trader do in this case, once the price break above one of the extremity of the range, nothing, absolutely nothing. We simply watch for a potential. In this situation is, since price has broken above, is just a potential deviation, and we wait if actually the price truly deviate. What does it mean? Deviate, go outside, and deviate back inside. So this is the moment the range breaks where we are alerted, okay? So we know that there was liquidity being built here, or potentially liquidity being built here. We see the price breaking, or we see the price breaking. Now we are alerted. Is this a real breakout, or is this a fake out, a liquidity hunt, a bull trap, or a bear trap, actually a deviation? We have to wait until the price deviates back inside. So the break is not your signal. The break is the setup that is potentially starting to load, but we are still in the potentially, in the probably. We are not sure. We are just monitoring. Our attention in this moment is really raising. So our attention is becoming very high. So we look for what? How aggressively prices move outside of the range. Did it happen with volume, or was without volume on thin air? This is more or less to give you a clue. High time frame levels are holding or not. So perhaps I know that historically this was a support level for Bitcoin. This break here went above this historical support level for Bitcoin or no, or we are still below. This break is a very strong break with a very strong daily, weekly candle above my range high, or is a teeny break, is just there and is holding and is not starting to fly away. So these are already on the break. The moment we are alerted, the moment we start to pay attention, but we are not yet ready to trade, these are already some signs that you can start to look on this break. Volume, how much is strong, how much is aggressive the move, and especially did something on high time frame changed? So a supply, a demand zone are being broken, or are keep still doing resistance support, this kind of stuff. So this is the moment where you really pay attention. If we want to look for the example I have here, as I was saying, you see this break above is a break above this clear resistance level that was tapped several times, but the break is not huge, is not so convincingly. Also, as I was showing you, here there is an historical support level, because price was supported all the time here, now is broken, so we break by above or we stay below this, we stay below this. So already I have signs in me formulating that this could truly potentially be a deviation. So the break is not the trade, the break is the bait, the trap for people that want to trade this continuation. They fall for this, they believe is a legitimate break, but it's not. So for us, range trader, deviation trader, this is not the trade. For breakout trader, this is their trade, but if the trade goes in the direction we want as a range trader, deviation trader, you will see it will become the bait of breakout trader. So this was the range breaks, the step number 2. The step number 3 on my exact 5-step process for trading range deviation is deviation back into the range. So this is, let's say, all we were waiting for. We saw the breakout, we saw the breakout, we saw the breakdown. We were waiting for what? The deviation. That's why it's called range deviation. So price, what does it do? It deviates back inside our range boundaries. So price went outside, it went for a walk outside, but after this walk, what does it do? It come back inside. After this walk, what does it do? It come back inside. After this longer walk, what does it do? It come back inside. So now, since the price went out and came back inside, we do have the deviation. So price come inside the value area, the breakout is failed. So this breakout failed, this breakout failed, this breakdown failed. If I push another one here, this breakdown failed. This one failed. So price went back inside the range boundaries. This is where it gets interesting. So all breakout traders are now trapped. Everybody try to long this is trapped. Everybody who try to short this is trapped, because price move once again in the direction, opposite direction they wanted to have. So their stop losses now are our fuel. So their stop losses is what will move the trade in our direction. Why? Because in this case, these guys here that looked for the breakout put their trade more or less like this. These guys that look for this trade put the stop loss like this, or this guy that were looking for this trade put their stop losses like this. We are range trader. Now what we do, we want to play the deviation. So now we will take out their stop loss. Their stop loss will be the fuel to move the price in the other direction. Their stop loss, you see how impulsive this move is because there was a lot of breakout trader with stop loss somewhere here, taking their stop loss, remove resistance and fuel liquidity wise further order to push the price down. Their stop loss was here. We deviated back and boom, we went inside. So the stop loss of the breakout trader is, for us, deviation trader, when we are in the right trade, is the fuel that will move strongly and positively our trade. What to look for? Speed of the return. Fast stronger the deviation signal, where exactly it re-enters back below value area high and value area low. So we want to see the deviation to come back. So we want to see price starting to breaking down, where or range high, or if you want to use the fixed range volume profile, you want to see the price pulling now quickly just to show you more or less the range was until here. You want to see breaking back inside the volume profile. Then here you can use many different strategies for this. You see volume area high is just there, or you see here reclaim, come back inside, retested and move to the other side. So to confirm the deviation, whatever is the system you use to mark range high and range low, could either be fixed range volume profile or parallel channel. Objectively, always use the same. Once you see the price back inside your boundaries, you have the deviation. So when the price leave the range and come back, the trapped traders become your liquidity. Are we ready to trade this? No, not yet. Just we had the first step of our setup, our trigger. We got the deviation. We'll see next what are the most important for the trade execution, that is 0.4 and 0.5. But since you are getting ready for trading a range deviation, make sure to prepare yourself and join X Pro with me by using the referral link down in the description below, where you can trade all this deviation on crypto and other pairs. If you use my referral link, you will get a discount on trading fees. You will have 0 fees on spot, or if you don't want to use the referral link, just use code POPEY. So VUX is basically the exchange where lately I'm trading most of my crypto. In crypto, there is a lot of range deviation setup specifically for the manipulation that is behind this kind of setup and behind generally the crypto space. So do not wait forward. Join VUX Pro with me. It's a super cool platform with a lot of liquidity. So you will be ready to trade the next setup that you will find with this strategy on VUX with me using the referral link down in the description below. So we saw the first 3 steps. We saw more or less, we know now that more or less to trade a range, we have to wait that the range form, we have to wait the range to be broken, and we have to wait to see the deviation being, the price being deviated back inside the range. So now we have to wait what usually in trading we call it, for my style, the trigger. So is what gives you a little bit more confidence, is never a confirmation, a little bit more confidence on your trade. So this is the filter that keeps you out of bad trades. So the trigger in this case for me is the market structure break that confirm the reversal. So let's start a little bit with the theory of this. Why we need a market structure break to confirm the reversal? Because we know we are in a range. We know that price more or less has been moving up, has been rejected, then has been moving down, has been rejected, then potentially is coming out. We finally have the breakout. Now we have the deviation. So what we want to see? We want to see that this uptrend here, low time frame uptrend that brought the price up to value area high, we want to see that this uptrend is broken. So we want to see a market structure break of this local uptrend, because this is a further confirmation. Is a further confirmation that we have a confluence of factor. The confluence is, we know that this is a range high that is potentially an area that is acting as resistance. We know that we have swept the high, we have taken the liquidity, we broke above and we deviated back inside, but maybe it's just something temporary and this uptrend will continue to do what has been doing until now, means uptrending. Okay, so we want to have this further trigger, this further confluence that this local low time frame trend is broken. So is broken on the opposite direction because we want to trade this deviation back down on the other direction. So we want to see this broken and then the price to come lower. So you need the market structure break in the direction of the main reversion on lower time frame. So depends on the time frame you're using for the range, perhaps 4 hours, 15 minutes, 1 hour, depends on the specific range. So what you need to have is for a long deviation above a bearish deviation above value area high, you need to have a bearish market structure break. For a bullish deviation below, you need to have a bullish market structure break to push the price, to confirm or to trigger your trade on the other side. So these are, let's say, the trigger, the confluence you need to see. And the reason is, again, we know that the price to come up there to range high was supposed to be in a low time frame uptrend. We want to see this uptrend broken, otherwise we risk to short an uptrend that is continuing to uptrend. No market structure break, this is very important, no trade, period. This is not negotiable. So this is a system, this is a setup that is built on several consequences. You have to wait to see all this process to be happening. You have to be patient, because if you wait all this step, your edge, your win rate will become much, much higher. So to show you some example, you can see here probably if we go on the 1 hour, this is probably the one that created the top of Bitcoin at 127, and I shorted this publicly. You can clearly see that Bitcoin is trading here in a bullish trend. And finally, there was a market structure break. So this market structure break gave you the trigger, the retest, and then the price moved lower down. So we did have the deviation in top of the range, we did have the market structure break, and then you can see price moved to the other extreme of the range. In this case, went much, much lower. Another example is this. You see price was coming down, deviated below the range, started to break structure here, and then moved to the other side. You saw there is a few market structure break, depending on the time frame you're looking, and it started to move to the other side. There is a situation like this one where you did have a market structure break, but perhaps entry were not so simple. You see, we deviated above, we break inside below, we definitely break structure here, but here the strategy to enter is a little bit more advanced. But again, market structure break was followed by a drop to the other side of the range. Or similarly, this latest range we form at the moment of recording, beginning of April, you see here this market structure here was broken, this high was broken, and price started to push lower. So this is a super important aspect that many people don't wait. If they have a strategy around it that is working, fine for them. But this video is my 5-step, and in my 5-step, the market structure break is really super important. So the market structure break confirm the reversal. The deviation tell you what might happen. The market structure tells you if it's really or most probably going to happen. So we reached the end of my 5-step process for trading range deviation, and this is the last one: entry, invalidation, and take profit. So this is, let's say, the bread and butter, the most important part to understand how to trade, and is let's say how I implement this practically. So the entry, as I was explaining until now, is after the market structure break confirmation, not before, not on the feeling. Here is where things get a little bit complicated. So there is the simple and standard one, that in this situation we were waiting for the market structure break. Just let me change the color so you can see the point here. So we want to see a market structure break below this level. We get the market structure break. Here our trade could start. So the first option is for you to enter on the market structure break and have not a very good risk reward, but you are already triggered. So maybe you will be underwater a little bit, but then price will finally go down. This is the one that I'm not recommending, to be frank. The best one is you get the market structure break. On this local low time frame structure, we look for a retest of Fibonacci level. So more or less you do this on this bearish move because there was a market structure break, and more or less we try to enter around the golden pocket or 0.75 and we look for down. We put in confluence maybe a supply zone that was formed here. Okay, so this is the super standard one, and this more or less what happened here in this short setup. If you look at this one, to give you a concrete example of the entry, you can see that here there was the market structure break. Okay, there was the deviation, price went back inside. Here there was the market structure break, so we take the Fibonacci of this move down, we try to enter more or less on this demand that created here, and in this case was a perfect retap of the golden pocket. So this is the first one. First kind of entry is market structure break. We try to look for supply and Fibonacci level of the retracement, we enter there, and that is the entry. The second one, that is a little bit more advanced, is once you see the market structure break, you look for little ranges to be formed, like in this case. So when you see little range to be formed and this little range start to break down, maybe you will be front run. So here you try to chase a little bit the entry, is let's say a little bit more advanced, a little bit more dangerous, but sometimes is needed because you see these little ranges breaking. So either you try to trade them and follow them, or you try to look for some local range deviation, same concept, and you enter somewhere here in the middle. I will explain this advanced level a little bit more on the third episode, where we will go a little bit more pro, more advanced on further concept, but let's say is to explain it here, you see okay, this is taking forever. Okay, you see the market structure break, and then you see a little range forming here. So this become another range where you use the same concept we explained so far, and you use this for trading. So maybe deviate below, come here, you try to short somewhere there. Something like this, a smaller range in a bigger range, or you see this range breaking down and you try to chase the breakdown because you know that is part of a bigger picture, a bigger range, a bigger deviation, and whatever. So you can see it also in the long side. For example, I think this is very interesting. Here there was a market structure break, and you can see we can just use the volume profile. You see that this range was formed, was broken above, come back, retest of the 0.75 level, and price pushed above. So this is the standard. You wait for the market structure break, you pull the Fibonacci bullish or bearishly according if it's a bullish or a bearish deviation and the structure, confluence with that supply as close as possible to value area high or value area low or range high, range low, and then you get your entry. So this is the entry, and always after the market structure break, not before, not on feeling. The invalidation, this is probably the most simple, always above or more or less around the deviation level. So always above the deviation, because there is the safest, the safe place to be, because that is already taken out everybody else, so should not come to take you out as well, because the deviation already happened. So to show you very simply, in this situation, wherever you enter, your invalidation should be, for me to be safe, a little above the deviation level. should be a little above your deviation level, or for the long that we mention here, a little below. In this case, the deviation was there. Your deviation level that was this level here. So always invalidation above the deviation high for the short, below the deviation low for long. This is your stop loss. If the deviation wasn't a deviation, you are out. So if the deviation was not a deviation, what does it mean? If this was not a deviation, price will come down and this will continue to go down. If this was not a deviation, for sure you will be out, because price again go outside of the range. If the price go outside of the range, what does it mean? That deviation was simply not a deviation. This, as all the setup, will win sometime, will lose sometime, so it's normal sometime to be stopped. So where is your invalidation? In a range deviation setup is where you believe is the deviation. Above that deviation, if price again visit above or below the deviation according if it's bullish or bearish, your thesis is invalidated, and it will happen that you will be invalidated. So do not expect this setup to work 100% of the time, because nothing in the market works 100% of the time. So you already got the entry, you got the trigger, you got the entry, you got the invalidation. Now the take profit. For me, take profit is super straightforward. We are in a range. So we explain at the beginning of the range that the range is composed by 3 relevant levels that are range low, range high, and mid-range. So for me, always a part of the take profit is at mid-range. Why? Because mid-range is, you see here, there was a little deviation. Price came down to mid-range and boom, went again up. So mid-range is a tough level to break. So we never know if this is the final deviation, like in this case that went down, or is a partial deviation, came down and came up here. You can see similarly in other situation. Okay, this is point of control, but you see push there, came down again. So we can see many other range, but for me, to be safe, the way I trade ranges is I always take part of the position 30 to 50% out at mid-range. So point of control is your TP1. The second TP is the opposite boundary. So very simple. We know that the deviation was here. We expect a visit here. So we TP a little bit here at mid-range, and the final part is at the extreme part of the range. So this should be the normal trade range deviation trade setup and TP. A pro tip here is that sometimes if you see that the range is being exhausted, so we have been for weeks, months, or long time according to the time frame in the range, maybe you can leave a 10-20% for like a moon bag or a dump bag. So you can take a little bit profit here, you can take a little bit profit here, 30 and 40 here, you still have another 30 to go in case what? The range finally break. Because yes, we are range trader, but yes, we are also aware that at a certain time a range will break. So if I have a very good entry here, I'm a range trader, so I take profit at the range key levels, but I have a very good entry. Maybe my stop is already flat. When I see the price here, I start to take some profit, but potentially the range will close back above. So this will give you a very big advantage in case the break really happen. So maybe sometime it will not, but the few times that you actually join this trade, let's give this example here, join this trade at the extreme up here, so we saw that more or less the entry was here, the stop loss was there, so we know in this case you would take some profit here at around 2R, already a good trade. You will take most of the profit here at 3.63R, but perhaps you can keep a 10-20% of the position to go where much lower. So in this case, even if you keep 10% of the position, the trade, the remaining part of the trade become an 8, 9, 10R, and you would be, let's say, very profitable at the end of the day. This depends a little bit on your risk tolerance or your patience or whatever. Let's say the range trade finish at the range extreme. But as a pro tip, if you are a patient person and especially if the range has been exhausted, so traded for very long time, according to the time frame. The extreme has been tapped many times. Perhaps could be smart to leave a little bit of part of the trade to run much longer. What is also important, as always, let's say to complete, is risk management. So is a good setup. I personally did a lot of money with this setup, but always with this risk management, because as I was saying, define your risk. Every trade can go against you, so make sure you apply a proper risk management, a proper stop loss. You have to know exactly what you lose if you're wrong. So that is the beauty of this setup. So 5 step, 1 range, it break, it deviate, it gave a market structure break, it gave you an entry, it's it. The rest will be the market to decide if you will go for profit or no. So a quick summary, a quick recap. This is the range trader trilogy. In episode 1, we saw why people lose money on the range. In episode 2, we saw my 5-step setup to trade range deviation. So we know that a range needs to be formed properly. We know that a range should break. We know that after the break, the price should deviate back inside the range, trapping breakout trader, creating a bull trap or a bear trap. We need to see a market structure break that break the low time frame trend that accompanied the price to the range extreme to have a more confluence, a sort of confirmation on our trade. Once we have all these, we explain in step number 5 how we place our entry, how we define our risk, where is our invalidation, and what are the standard and a little bit more pro way of taking profit. All of these we always do with proper risk management, so we define risk. This setup might work and works on any time frame, any asset. I see it working a lot on Bitcoin, Ethereum and altcoin, so mainly crypto. It works a little bit also on TradFi, but personally I backtested and use it personally basically on crypto, mainly in crypto and especially Bitcoin and Ethereum. Especially Bitcoin and Ethereum are assets that range most of the time, 70-80% of the time, so you will see this setup over and over and over again. The structure is the same, the setup is the same. So finally, episode 3 will drop next week, will be 5 advanced signal and tools and tricks that add more confluence to this setup, like RSI divergency, the 3 drives, the range within range that we saw a little bit in this episode. So make sure to be subscribed to the channel so you will not miss episode 3, that will be the conclusion of this trilogy, and this the episode that will bring you from good, probably you are reached episode 2 and you are already good in the range trading, to an elite range trader. As always, if this has helped, make sure to leave a like and a comment, subscribe to the channel, make sure to protect the capital, protect the process, and we'll see you in the next one. Bye.